Hello, everyone. We will be presenting on the home and automobile decision by Nancy Williams, Ale Gomez, Nico Lanes, Scott Burke, and myself, Aaron Kahn.
And here are a few photos of our beautiful and talented young team. Living in a consumer society, we make several purchases every single day. Some are minor, like buying a Coke from vending machines, while others are more consequential. For these larger buying decisions, it is important for us to follow certain steps to ensure that we make financially responsible decisions. The first step in the smart buying process is to differentiate want from need. While this step may seem pretty straightforward, most people struggle with it. The second step is to do your homework. This is one of the most important steps in the process. Before any major purchase, it is necessary to do research on the market to find out the price range, differences in quality, what you can afford, and the best value for your money. Step 3 is to make your purchase. Some purchases may just involve going to the right source, while others have an aspect of negotiation. Before any negotiation, make sure you know the terms, have a goal in mind, have options, and don't be afraid to walk out if the deal isn't working. The final step in smart buying is maintaining your purchase. This is entirely dependent on the nature of the purchase, but whether it is physical upkeep or negotiating better financing, this step is necessary to ensure smooth sailing and a long life for your purchase.
One place where we can see smart buying in action is when it comes to buying a vehicle. Very few decisions demonstrate differentiating need from want like an automobile decision. For many people, a car is not just about what they need, but they want it to reflect who they are. It is important to separate your needs from your wants in order to be financially savvy. Your facts of life will dictate what it is that you need, such as the size of your family or what you do for work. You also need to consider a new or a used vehicle, or whether you would like to lease or buy. The percentage of cars that have been leased have gone up significantly in the past 15 years. This is largely due to sticker shock, as a car is a large investment. Because a car is a large investment, it's important to do your homework. First, determine the size of your down payment. This will be different for everyone. Using savings for down payment is perfectly fine if they were set aside for that purpose. You don't want to be using money that was saved for a college fund or retirement savings. Most families spend 4 to 6 months of income on a new car, which is significant. The most important determinant in what you can afford is if you will be able to sustain your lifestyle while making your vehicle purchase. Shop around at different banks or credit unions and ask about auto loan rates to get yourself the best deal. I have an example here on the right-hand side that can show the monthly payments that would be made on a loan. It's for a 24-month loan of $20,000 with payments made monthly and an annual interest rate of 8%. As you can see, the monthly payment is $904.55. Only you will be able to determine if you will be able to pay this for the duration of the loan. As I've mentioned earlier, you need to decide on a new or a used vehicle. As you can see, the sticker prices for these vehicles vary greatly. The price of a new car is much higher than that of a used car. However, this doesn't tell the full picture. You also need to consider operating and insurance costs as well as warranty. Used vehicles typically have higher operating costs as they need more repair and they may not be under warranty. Warranty can give you insight into the future costs of repairs. Additionally, a car must fit you physically as well as financially, so always be sure to do a test drive. When it comes to deciding whether you would buy or lease a vehicle, it's important to compare these for the same period of time. If the lease is 2 years, compare this to the cost of buying for 2 years. I have an example on the right side from the textbook that demonstrates this very clearly. The price of a lease is determined by how much the value of the vehicle you're leasing is expected to depreciate during the lease, as well as finance charges. There are two kinds of leases, closed-ended and open-ended leases. Closed-ended leases make up about 80% of all leases, and it's where you return the vehicle at the end of the lease in good condition and essentially walk away from future responsibility. It may include a purchase option at the end of the lease for a residual value or a fixed price that was determined at the point of the lease contract. An open-ended lease is less common, and it's where the current market value at the end of the lease is compared to what was estimated at the point of the lease contract. You must pay the difference if the vehicle is worth less than it was thought to be, which can be a hefty amount. Once you have considered all of these factors, it's time to make your purchase. First, determine what the dealer paid for the vehicle. You can do this on Edmund's car buying guide using the link provided. However, this doesn't give you the full picture. You also need to be mindful of the holdback, which is the amount that the dealer receives from the manufacturer, which is generally 2 to 3% of the price of the vehicle. Edmunds recommends not trying to negotiate for this holdback, but mentioning it if the dealer says they are not making any money on the deal during negotiations. I've included an example here that shows how a holdback can increase the markup significantly. Also, shop around and keep financing out of negotiations, and take your time when it comes to purchasing a vehicle. Once you have made your purchase, it's vital that you maintain it. Set up a car file for all car-related paperwork, such as insurance and warranty. Also, don't ignore signs of trouble. Listen for unusual sounds and watch for any changes in functioning and performance. Lastly, be mindful of lemon laws, which protect consumers when they purchase a vehicle that fails to function as it should. These laws typically require 3 to 4 repair attempts within 1 year and around 12,000 miles. The settlement is the purchase price adjusted for usage, and it's recommended that you use the free arbitration offered by every manufacturer so you don't lose some of your settlement to a lawyer.
Moving on to buying a home, we will be exploring strategic home buying approaches that streamline the process and optimize your investments in the real estate market. Let's dive into how you can make informed decisions and maximize values as a potential homeowner and the process you need to go through before making your first purchase. Before we go into the process of buying a home, I wanted to talk about some of the key factors to consider when making your purchase. Owning a home is not just about having a place to live. It represents financial stability, personal accomplishment, and a space that can be tailored to your life transition. First, let's discuss the optimal age for buying a home. There isn't a one-size-fits-all answer, as the right time varies based on individuals' financial circumstances and life goals. We'll explore how to determine when you're financially and personally ready to take this significant step. Next, choosing the right type of house is very critical when making your purchase. This decision depends on various factors, including the size of your family, the importance of location, the need for privacy, your personal lifestyle preferences, and work commitments. Each element plays a pivotal role in selecting a home that suits your long-term needs. Lastly, for those who are first-time homebuyers, understanding the different type of housing, such as houses, co-ops, condos, and apartments, and their respective maintenance requirements is essential. We'll break these options down later to help you make an informed decision tailored to your situation. As we move to our next important step in smart home buying, it's critical to differentiate between what you want and what you really need. Understanding this distinction is key to making practical decisions throughout your home buying journey. First, determine your most important factors. Remember, no option will be perfect, and compromise is often necessary. It's about prioritizing what's absolutely essential for your living situation versus what could be adjusted or upgraded later. It's also very important to establish your budget. It's vital to have a clear idea of what you can comfortably afford without stretching your finances too thin. Generally, your housing costs, including mortgages, taxes, and maintenances, should not exceed 25% of your after-tax income. This threshold ensures that home ownership remains a benefit, not a burden. Lastly, view home ownership as both living space and investments. This dual perspective will guide you in choosing a property that not only meets your immediate needs, but also contributes positively to your financial health over time. Now that we've differentiated your wants versus your needs, it's time to do your homework. This step involves researching properties that align with your housing preferences and budget. The more informed you are, the better choices you'll make. You should leverage online tools that are free, such as Zillow and HomeFair, or some that have a small fee like Neighborhood Scout, to explore properties, neighborhoods, and pricing. These websites allow you to filter options based on your criteria, providing valuable insight into potential homes that match your need. It's also crucial to understand how the payment structure works for each housing option. This includes researching mortgage rates, taxes, and other financial details. Knowing how these payments are structured will prevent surprises later on. We'll also look at two types of cost involved: one-time costs, such as your down payment and closing fees, and recurring costs, like monthly mortgage payments, insurance, and taxes. Don't forget about maintenance and operating costs, which can vary depending on the type of home you choose. These hidden expenses are often overlooked but can have a significant impact on your long-term budget. In this step, research is your best ally. By fully understanding these elements, you'll be better equipped to make a confident and informed decision. Moving forward in our home buying journey, it's vital to fully grasp the spectrum of costs associated with purchasing and owning a home. These costs can be categorized into one-time, recurring, and maintenance expenses. For your one-time costs, these are upfront charges you'll pay only once but are significant in getting the keys to your new home. They include cash for down payments. This is mainly due because no one is paying for their house at one time in cash, so you will probably need a mortgage to pay off the loans. So this is the largest initial expense and varies based on your mortgage type and lender requirements. You also have your closing or settlement costs, which includes a range of fees such as your appraisal fees, attorney fees, and title insurance. This is usually 2 to 5% of the purchasing price. There will also be recurring costs. The ongoing expenses related to financing and owning your home will include your mortgage payments. These are often your biggest recurring expenses. Let's look at the table displayed here, showing how the monthly payments vary with different interest rates and loan terms. For instance, a $10,000 loan at a 5% interest rate over 30 years would necessitate a monthly payment of about $53.68. This example helps illustrate how the amount borrowed and the terms of the loan affect your regular payments. Lastly, there's also your maintenance costs, which you can't forget about. These include repairs, upgrades, and landscaping, and these are less predictable than your first two one-time payments and recurring, as in some cases you could be in charge of when you choose to upgrade, or in certain cases repairs may be necessary on your home. The last step in the home buying process is making and maintaining your purchase. Most people need assistance in buying a home. About 36% of people attempt to sell homes on their own, but then end up needing help from a real estate agent or a professional. It's important to understand that a real estate agent, while helpful, often primarily represents the seller's interests. This knowledge is key to navigating your interactions and negotiations with the agent. It's also very important to have an action plan to make buying as easy as possible. Having an actionable plan is crucial for a smooth buying experience. This plan should outline each step of the home buying process from initial research to closing the deal. You should also prioritize financial preparations. Your first financial goal should be saving for a down payment, which can significantly impact your loan's conditions and affordability. Pre-qualify for loans to gain a clear understanding of what you could realistically afford, which will guide your property search and budgeting from the beginning. Lastly, it's also very important to do due diligence. Before finalizing any purchase, you should have the property thoroughly inspected by professionals. This step is vital to ensure that there are no hidden issues with the property, securing your investment and future home. By understanding these elements and preparing accordingly, you could navigate the complexities of home buying with confidence and clarity.
Now we will look at how you can determine what you can afford and whether you should rent or buy. For many people, the rent or buy decision focuses on their lifestyle and what is most comfortable, convenient, and affordable for them. The cost of buying or renting is usually the driving factor, with the biggest variable being how long one is planning to live there. With a house, one experiences many upfront one-time costs. On the other hand, there are some major financial advantages that come with that, such as price appreciation and tax benefits, which come gradually over time. With renting, one does not have those upfront one-time costs. One usually just has a security deposit that is returned once you move out. The main cost of renting is the rent itself. Another example of a cost might include renter's insurance. Here are some of the facts to ponder when making a decision. For renting, one has the ability to end their lease and easily move to a different location and rent somewhere else. Also, there is no down payment due when renting, unlike buying a house. There is also a lower monthly cash flow with renting, unlike buying where one has mortgages, taxes, insurance, and upkeep. Renting also avoids the risk of a failing house price and in the event of another crash. And lastly, many times amenities such as a pool, spa, gym, and more are included when renting. When thinking about buying, one has to take into the fact that you will be building equity over time as one purchases their house. There will also be the personal freedom to remodel their place and style it any way they would like to, unlike renting. There is also a significant tax advantage, such as deduction of interest or property taxes. When buying, you will also not experience rent increases over time, and your home will also be a potential source of cash in the form of home equity loans. When looking to buy, the first thing one has to ask themselves is, how much can I afford to spend? In order to answer that question, you have to answer these three questions. What is the maximum amount that the bank will lend me? Should I borrow up to the maximum? And how big of a down payment can I afford? Regarding the first question, banks will consider 1. Your financial history, 2. Your ability to pay, and 3. The appraised value of the home you are interested in purchasing. In evaluating your financial history, lenders will generally focus on the steadiness of your income, your credit report, and your FICO credit score. As for the mortgage limit, the maximum loan you will qualify for is determined by the financial picture that develops as a lender reviews the three measures of your ability to pay. Taking on a mortgage is a large commitment of future earnings, and one might not want to borrow as much as they are allowed. When thinking about how much one should borrow, the main two answers needed are, will it affect your retirement goals? And will you no longer be able to maintain the lifestyle that you want for yourself? One should not allow mortgage payments or any other debts to control their life. Look at your own financial situation and plans, monthly budget, goals, and lifestyle, and decide for yourself how much you are willing to and will allow yourself to take. Within the abilities to pay, there are three ways lenders measure what they are willing to loan. The first method, principal, interest, taxes, and insurance, to monthly gross income, looks at the percentage of your gross income that goes to housing costs. Lenders would like to see this ratio at a maximum of 28%. The second method, PT plus other debt payments to monthly gross income, looks at PT plus any other debt payments that will take over 10 months to pay off, such as credit card debt, student loans, and car loans. In general, lenders would like to see this ratio at a maximum of 36%. Lastly, the third method, appraised home value, follows the 80% rule, where most lenders limit mortgage loans to 80% of the appraised value of the home. This rule protects lenders by forcing the borrower to put up a substantial down payment. Therefore, if the borrower defaults, the lender assumes possession of the home, and the 80% limitation protects the lender.
Hello, my name is Nico, and I'm going to be demonstrating how to finance your mortgages. The first step in financing your mortgage is calculating your mortgage limit. There are three distinct methods that lenders use in order to calculate your mortgage limit. The first method is the ability to pay the PC ratio. The second method is the ability to pay PD plus other debt payments to monthly gross income. And the third method is the appraised home value. The lowest amount of the methods is used to determine what mortgage loan you qualify for. So method number one is the PD ratio. Lenders measure your ability to pay off loans through the use of ratios. Lenders limit your monthly housing cost as measured by PD to a maximum of 28% of your gross monthly income. So here I'm going to walk you guys through an example of how to translate the PD ratio to your personal finances. So step one is to determine your monthly income. And you're going to do that by doing your annual income divided by 12. So in this case, your annual gross income is $65,000. So you're going to do $65,000 divided by 12 and you get $5,417. Step two is to multiply your monthly income times 28%, which is the PD limit. So you're going to do 5,417 multiplied by 28% and you get $1,517. Next, you're going to subtract your estimated monthly real estate taxes and insurance payments in order to obtain your maximum monthly mortgage payment. In this case, your monthly real estate taxes and insurance payments is $200. So you're going to do $1,517 minus $200 and you get $1,317, which is your maximum monthly mortgage payment. And then in order to obtain your maximum mortgage loan level for what you qualify for, you're going to use your financial calculator Excel and you're going to do the number of payment periods, which is 30 times 12, which equals 360. Your interest rate, which would be 8 divided by 12, you get 0.66%, and your payment is negative $1,317. Your future value will be 0, and what you qualify for the loan using the PD ratio is $179,485. So method number two is the PD plus fixed monthly payments ratio. So lenders also look at the ratio of your PD plus any other debt payments that will take over 10 months to pay off compared to your monthly gross income. Lenders use 36% of your total current monthly fixed payments to determine the amount of your loans. Now here we're going to walk you through an example of how to use this method using the same assumptions. So for this first step, you're going to determine your monthly income, which would be your annual income divided by 12, which would be $65,000 divided by 12, which equals $5,417. The next step would be to multiply your monthly income times 36%, which is the PD limit, and you get $1,950. The next step would be to subtract your current non-mortgage debt payments and estimated monthly real estate taxes and insurance payments, and you get $1,350, which would be your maximum monthly mortgage payment. So using your financial calculator or Excel, you get the number of periods is 360, your interest rate is 0.66%, your payment is negative $1,350, and your future value is 0. So you're looking for your present value to find out what loan you qualify for is $183,982. So method number 3 is the appraised home value method. In this method, you pay 20% of the appraised value and can borrow 80% of the appraised value of the house. This protects lenders on the loans by requiring a down payment and allows them to recoup their losses if a borrower defaults on the loan. So using the same assumptions, we're going to walk you through how to use the appraised home value method. So step number 1 is you're going to use the funds available for down payment and closing costs and subtract the closing costs. So in this case, it would be $56,000 minus $10,000, and you get $46,000. This $46,000 would be the funds available for the down payment, which would be the 20%. The next step would be to multiply the down payment by times 4, and this would equal your maximum mortgage level that you qualify for. So you do $46,000 times 4, and you get $184,000, which would be the 80%. So in this case, the maximum loan that you would qualify for is $184,000. In using all the methods to determine the loan amount that you would qualify for, you'd use the PD ratio with the loan amount of $179,485 because you used the lowest amount of all the methods. So now we're going to talk about conventional versus government-backed mortgages. So conventional mortgages are loans from a bank or a savings and loans association. They are secured by property being purchased, and if you default on a mortgage loan, the lender seizes the property, can sell it, and recovers the funds owed. They also require higher credit scores and larger down payments. What are the advantages? So the advantages are you can obtain a larger loan amount, there's no mortgage insurance premiums, they have competitive interest rates, and they're easier to refinance. So in a government-backed mortgage, traditional lenders make the loan, but the government insures it. There are two primary types, the Veterans Administration, the VA, and the Federal Housing Administration, the FHA. So to qualify for an FHA loan, you need to have a minimum FICO score of 580 and be able to provide a minimum down payment of 3.5%. In order to qualify for a VA loan, it's only for veterans and their families. So what are the advantages of government-backed mortgages? So the interest rates are 0.5 to 1% below conventional mortgage loans. The FHA down payments are as low as 3.5%, and there's no down payment required on VA loans, and they have less strict financial requirements. So now we're going to talk about fixed rate mortgages versus adjustable rate mortgages. In a fixed rate mortgage, monthly payment doesn't change regardless of what happens to the market interest rates. The term is generally 15 or 30 years, and they carry an assumable loan, which is a loan that can be transferred to a new buyer who pays the same initial interest rate. They also have a prepayment privilege, which allows borrowers to make early cash payments, reducing the amount of interest due. What are the advantages? So you know what your payments are and can plan for them in advance, and they also limit financial risk. Now, adjustable rate mortgages. So in adjustable rate mortgages, interest rates fluctuate according to current market interest rates within the limits and specific intervals. They generally charge a lower rate of interest, and they're favorable to borrowers when interest rates drop. What are the advantages? So the advantages are the initial rate is lower than that of the fixed rate loans because the borrower assumes the risk that interest rates will rise. And you could also qualify for larger loans because your monthly payment, your PD, is lower. Another option that homeowners have are specialty mortgage options. Listed below are a couple examples of some types of specialty mortgage options. The first one is the balloon payment mortgage, in which borrowers make small monthly payments for several years, usually 5 to 7 years, and then after the loan becomes due, you must pay it off in one large payment. The next one is a graduated payment mortgage, in which payments are set in advance so that they rise steadily for a specified period, generally 5 to 10 years, and then level off. In this, initial payments are low. There's also a growing equity mortgage, in which home buyers' payments increase 2 to 9% each year, helping pay off a mortgage at a faster rate. And then there's interest-only mortgages, in which pay interest payments for an initial set period, and then after that period ends, your monthly payments are adjusted upward to reflect the full amortization of the remaining years on the loan. So what are the risks associated with them? So the risks are that they are an adjustable rate loan and they can significantly increase your monthly payments. So before you do this, you need to make sure that you can be able to afford it and know what your payments are.